Hello, welcome to all. In this video, we are going to discuss about strategic analysis of operating income. What is meant by operating income? Operating means business income means whatever business you are doing. For that business, you earn some income for operating the business. That is operating income. For that operating income, we will analyze in a strategical way. That is known as strategic analysis of operating income. Okay. Here overview will be profitability analysis. Here we will do the strategic profitability analysis, ABC, ABM, ABB, and profitability analysis through activity based costing. And here strategic profitability analysis will be product differentiation, cost leadership, growth. Product differentiation, cost leadership, growth. And ABC, ABM, ABB, that is ABC in advanced manufacturing environment, activity based cost management, activity based budgeting, decision making tool. ABC. Next, profitability analysis through activity based costing, direct product quality and customer profitability analysis. Next, ABM will be value added activity, may be some non value added activity. Here value added activity and non value added activities means if you take some derivative, if one item is manufacturing, for manufacturing they have processing time, setup time, and their processing time, and taken come time. This all time is there. For which time is you add to value to your value, which time is add value to your activity, that is value added activity, and which is non value added activity, that is that setup time and taken come that goods to the one place to another place, it is not value added. That is known as value added activity and non value added activity. Okay, here strategically profitability analysis will be, we will bifurcate to profitability analysis. Strategic profitability analysis means operating profit of a firm is affected by various components which may be responsible for changes in the revenue and cost. Here the components for the majorly there are three components for this strategic profitability analysis. First, strategic profitability analysis, that three were growth component, price recovery component, product component. In growth component we have two, a revenue effect and cost effect. Cost effect may be fixed cost or variable cost. And profit recovery components. For growth component, it will be a quantity of output sold, whatever the quantity of output change is there, no, that is growth component. And where price recovery component is, it is a operating income measured change in revenue and cost, it is known as price recovery component, and it has revenue effect, cost effect. And productivity component here, this is also a one measure in a operating income. It will be due to product mix or yield of inputs compared to the last year. This is known as productivity component. Growth component, price recovery component, productivity component. Okay, for this component we will have for their own formulas. For growth component is change in the quantity of output sold, and growth component of change in operating income, that is there may be increase or decrease in revenue or cost due to selling or more less quantity. So this formula will be, revenue effect formula will be, and cost effective formula will be. Revenue effect formula will be actual units of output sold in current year minus actual units of output sold in last year into selling price in last year. This will show that how much it was increased or how much it was decreased in revenue. And cost effective growth measures means units of inputs recovered to produce current year output in last year minus actual inputs of inputs used to produce last year's outputs into input in last year, input price in last year. This we will show that what is the cost effect. It may be selling more or less quantity, we will find out that. Next, cost effect of growth for fixed cost. It will be actual unit of capacity in last year if advocated to produce current year's production in last year minus actual unit of capacity in last year into price per unit of capacity in last year. Next, price recovery component is here, it will component, it is change in operating income. It will measure change in revenue and cost solely due to change in prices, and here the revenue effect will be selling price in current year minus selling price in last year into actual units of output sold in current year, Next, what are the cost effects? Cost effects may be cost effect for variable cost, input price in current year minus input price in last year into units of inputs required to be produced in current output in last year. Next, what is the fixed cost effect? Cost of effect for price per unit of capacity in current year minus price per unit of capacity in last year into actual units of capacity in last year if advocate produced current year output in last year. Next, productivity component. Productivity component means it is also a one measure. And it will measure the change in operating income due to change in product mix. If you have any change in your product mix, and this will calculate the measure. And yield inputs as compared to last year. This component used current year's prices of inputs to measure the changes in cost only. Cost effects will be variable cost, maybe fixed cost. Next, they provided one reconciliation of operating profit. How may reconcile? First, we will take the opening profit in last year. What is the opening profit in last year? And for that, cost and revenue will be added or deducted. That is, add or less revenue and cost effect of growth components. If it is a favorable, add. If it is a adverse, negative. And revenue will be same. If it is a favorable, it will be added. Next, revenue and cost effect of price recovery components. If it is a favorable, add. If it is a adverse, deduct. And in cost effect of productivity components, where it is only related to cost only, it will not affect the revenue. If it is favorable, it will be added. If it is adverse, deducted. Next, from that opening profit in current year, revenue minus cost. For this, they provided one illustration. For illustration 1, what is there in illustration number 1? They provided that Y Limited is a manufacturer of cardboard boxes, and analysis of its operating income between 2020 and 21. Okay, what they provided: income statement for current year and in revenue statement for current year, and revenue cost and statement for current years, and income statement for previous year was provided, and remaining all were provided for current year information. And they provided favorable or adverse. If it is a favorable, we will add back, and if it is a adverse, we will deducted. So that what is there? Okay, first revenue was provided. For revenue, what can we do now? First, what is the first we see the question required. What is required? Compute how much of the change in operating income for 2021 is due to the industry market side factors, productivity and product differentiation, and also reconcile the profit of both the years due to these factors. So we require to reconciliation. Already we know that reconciliation statement with this is reconciliation of operating income. This is the reconciliation statement. We will calculate this reconciliation statement, and for this reconciliation statement we require operating profits. We will be added to 3 items, that is changes due to growth. What is the growth? And changes due to effect price recovery and productivity components. For productivity components, only the cost will be, and we will get the operating income of current year. In current year, last year will be taken, and we will add or less, and we will get the operating income. Next, here for we have the formulas. Revenue and cost effect of growth formula will be current year will be taken into increase in share units due to market growth divided by total growth in sales for last year to year. We will take that. And for productivity components, we will have productivity components if they provided. Okay, we will calculate that. Next, after that, cost effective will be product differentiations. What is there in we will calculate that. Okay, what is the information provided? That they provided revenue, okay, cost and operating income. So operating income 2020, it is the opening income, so we will take 10 lakhs 80 will be operating income. For reconciliation statement of reconciliation of we will start with reconciliation of operating income particulars and amount. We will take the operating income first, 10 lakh 80,000. Okay, for this 10 lakh 80,000, what we can do, for this, how much, okay, revenue and cost effects was provided. Revenue and cost efficient effect of price recovery component was provided. Cost of productivity component was provided. 3 items was provided. Okay, and for this, what is there, first to what we can take, revenue of cost efficient, revenue and cost effect of growth components, that is they provided that 2 lakhs favorable and 2 lakhs favorable and 60,000 is adverse. Okay, and for 4 lakh 20 was favorable. This is revenue cost and effect of price recovery component 2021, that is 4 lakh 20 was favorable and 2 lakh 56,000 was adverse. Okay, total income statement for current year was 14 lakhs 42,000 operating income. So 14 lakhs 42,000 will be taking lastly. So first head will be 10 lakhs 80,000 and last one will be 14 lakhs 42,000. In middle we will get the 3 items. That is what is the changes is there, no, that changes will be we will get. For changes we will see that Y Limited sold 4 lakhs boxes. And 420 boxes in 2020. So they sold that boxes. So there may be for current year 21, that is 4 lakh 20 through 20 for last year, which will be 4 lakhs. So 4 lakh 20 minus 4 lakhs, it will be 20,000 was increased. Okay, next, during 21 the market of cardboard boxes grow 3%. So it was grow 3%. So what is the last year 4 lakhs was there, for 4 lakhs into 3%, 12,000 was increased, and for increase in sale was 20,000 and was during market card boxes was increased to 12,000, and due to growth of market growth was 12,000 and sales growth was 20,000. Okay, and after that they provided in terms of number of units, and all other changes are due to company differentiation strategy and productivity. Remaining all are differentiation strategies. So for this point, what is the remaining box due to increase in market share? Firstly, there was increment, that is 4 lakh 20 minus 4 lakh, that is 20,000 was increased. In 20,000 we have 12,000 due to growth in market size. Remaining 8,000 will be increased due to market share. Okay, next, for this it is a revenue cost growth components. So for this 12,000 was there, 12,000 was increased, and for remaining was 1 lakh 40 into 12,000 divided by 20,000. Whatever the industry market size we will get, that is they are provided favorable. So and we also increased, so it is a favorable way. That is first one. And after that they provided cost effectivity of productivity components. Last year not there, so operating income 58,000. Okay, we will take directly 58,000 only. And next, this next amount will be 1 lakh 40 into 8,000 boxes divided by 20,000, that is related to market share. And remaining amounts 4 lakh 20, 2 lakh 56,000. 4 lakh 20 is favorable minus 2 lakh 56 adverse, so it will be deducted. And what is the favorable market growth share? We will get that 1 lakh 40 into 8,000 divided by 20,000, that is 56,000 we will get for this amount. So answer will be, what is the answer? Operating income in 2020 10 lakhs 80,000 you will get. Okay, last year will be first taken, and current year operating income will be end 10 lakhs 80 14 lakhs 42,000. And for this, change in due to industry market size, change in due to productivity, change in due to product differentiation. For this, working was provided. First, what is there? For year there was sales was increased to 20,000. Out of this 20,000, how the 20,000 was increased? 4 lakh 20 minus 4 lakhs 20. Out of this 20,000 was 12,000 due to change in market size, and next 8,000 due to change in market share. Okay, for this, effect of industry market size will be second. For market size, what amount they provided? 1 lakh 40 was provided. 1 lakh 40 into 12,000 boxes divided by 20,000. 20,000, this is 8,000, 84,000. So 84,000 was favorable. We will add it back to the 84,000 due to change in industry market size factor. Next, productivity and operating income, they are provided directly 58,000. So 58,000 will provided due to change in productivity. Next last one was due to change in product differentiation. That is, they provided increase in selling price 4 lakh 20, increase in price of inputs will be 2 lakh 56,000. That is, advance was provided, and growth in market share due to product differentiation will be 1 lakh 40 into 8,000 boxes divided by 20,000. That is 56,000. Total amount was 2 lakh 20. So 2 lakh 20 we will take here, 2 lakh 20. So the amount will be 14 lakh 42,000. So 10 lakh 80,000 plus 84,000 plus 58,000 plus 2 lakh 20,000. So 14 lakh 42,000. We will get the class verification must. So we will know the upward answer and downward answer later that. Profitability analysis through activity based analysis. Here for activity based analysis, for this activity based ABC analysis, we will have profitability analysis through activity based analysis in here, in which becomes an important aspect of manufacturing or service organization. Activity based is important for manufacturing and service organization. It is defined a methodology. And cost performance activity, resources and cost objective will be taken. And here it acts as a aid to management evaluation and decision making. It will act as like a aid to management evaluations and decision making. And if it is a service sector, the direct costs are generally low. For service sector, the direct costs are generally low, and overhead do not have volume related to capable of being easily attributable to product or service or customer being supplied. Here ABC will help to cost to identify easily and manage more effectively. It is also for service sectors. And there, next, if it is a resource consumption by product for different products, customers, segments of business is more accurately measured. Activity based profitability analysis is like provide more useful information to the management. So 4 points will be remembered for the profitability analysis through activity based costing. So that is, first one will be, it will be important for manufacturing and service organization. And for what purposes? For cost performance activities, that is resources, cost objectives, and management will evaluation and decision making will done by this ABC. Next, if it is a service sector, the direct cost of generally low, they will be generally low, and overheads will not be volume. So ABC will identify the easily and manage more effectively. Next, resource consumption, where here the different products, customers, segments of business more accurately will be measured by using the activity based measure. Next, here we will have direct productivity profitability, DPP. Here DPP, what is the DPP? It is a basically used primarily within retail sector. It is used within retail sector. What is DPP involves? It involves attribution of both purchase price and other indirect costs. For example, if you take distribution, warehousing, retail, these all are for examples for DPP, direct profitability, direct product profitability to each product line. Next, here the net profit will be opposite to gross profit. Here net profit will be opposite to gross profit. Here for can identify for each product. Next, whatever the cost attributable for process utilize a variety of methods. That is example warehousing space and transport time. To it will reflect the resources consumptions of individual product. That is DPP. What is the benefit of DPP? The benefits of DPP will be cost analysis, pricing decision, cost analysis, it will benefits of DPP, cost analysis, pricing decision, management of stores and warehouse space, rationalization of product ranges. That is 5. That is 5 benefits: cost analysis, pricing decision, management of stores and warehouse spaces, rationalization of products. Next, DPP statement. DPP statement. What is this DPP statement? Here the indirect cost for DPP may be analyzed into basic cost categories. That is follow that it will analyze into basic costs. What are the basic cost? Overhead cost, volume related cost, product batch cash, inventory financing cost. Overhead cost means what? It is incurred through an activity that is not directly linked to the particular product. Overhead cost means it is not directly linked to the particular product. Next, where volume related product cost means cost will be incurred in relation to space occupied by the product. This includes storage and transportation cost. Where product batch cost is it is a one time often time based cost. It is a time based cost. If any product that is number of identical products which are handled together has a batch, then we will incur this product cost. Stocked slaves of labor time cost incurred. Next, inventory financing cost. Inventory financing cost is a cost of timing of money in stock and is the cost of product multiplied by interest rates per day or per week. If you take any financing for inventory, we will have inventory financing cost. So DPP statement has indirect cost. It will analyze the basic overheads. What are the basic overheads? Overhead cost, volume related cost, product batch cost, inventory financing cost. Overhead cost is not directly linked to the cost for particular product. Volume related means it is incurred in relation to space, that is storage, transportation. Next, product means it is a time based cost. Next, inventory financing cost means cost typing of money into stocks. That is next. Here the DPP statement derived will be sales minus cost of goods sold minus sales minus cost of goods sold. We will get gross margin less direct PPP, direct productivity cost, product cost, that is warehouse, transportation, stores. Next we will get the direct product profit. That is the provided table 1. So for that they given that direct product profit of product A will be selling price 150, bought in price 80, and gross margin we will get 70 rupees less direct product cost, warehouse cost, transportation cost, store cost 22, direct product profit we will get. Direct profit we will get. Next, this is related to that. And if you see the table 2 they provided. Is there any directly given example? Okay, table 2, ice cream of body, baby food, toothpaste, wine, paper, tissues. That is they provided gross margin and DPP percentages. Okay, next you will see this illustration number 2. For these tables they provided after that we will see the illustration number 2. In illustration number 2 they provided that GST India Limited GIL has 30 retails. It has 30 retails. Okay, what is happened for 30 retails? If we have, it has sizes of fruity and sweet retails. So out of 30 retails, sizes, fruity and sweety retails across the country. Mainly three products was main: butterfly, butter jelly, fruit nuts, and icy cools. Icy cools are through these retails. So it has 30 retails. Out of the 33 retails, 3 products are main. While all stores they will sell. Next, GIL maintain the stock all retail stores in centralized warehouse. Goods released from warehouse to the retail stores as per requisition raised by the stores. So, if any stores was asked, they will send the goods. Goods transported to the stores two types. It will be transported to normal and it will be transported to refrigerated. Normal means without AC. Refrigerated means they are providing with AC. So, with cooling, with storage facility, they are transporting. These vans are hired by GIL. So it is a higher, so they will charge for higher. Okay, firstly what we will see now, we will see what is required. Calculate profit per unit using direct productivity profitability method. So for DPP we will calculate DPP statement wise we will get the profit, and after that profit we will divide the units, we will get the per unit basis. Okay, for DPP we have 3 products here. The 3 products, what are the 3 products? Butter jelly, fruit nuts, and icy cools. For these 3 products we will take sale price and deduct the expenses and we will get the profit, and for that profit divided by units we will get the DPP units per units. Okay, next here cost per month, they are provided cost per month for GIL. Okay, what is their warehouse cost? They are provided warehouse cost. Okay, what amount was provided? Labor and staff cost was 27,000. This is provided per month. They are provided. Okay, per month. For labor and staff 27,000 was provided. Okay, refrigeration cost will be 1,52,000. This labor and staff cost will be come under general cost, and refrigeration cost will be come under cost related to refrigerator. We are two types of van is there, no? The 2 types of van. For refrigerator we will get the refrigeration cost 1,52,000. Next, material handling cost will come under for general cost 78,000. Next, what is given? 2,07,000. It will be total 2,07,000. Okay, next, head office cost is not related because it is not controllable by the divisionals. It is not relevant. Salaries and wages of to the head office staff, it is not required. Office administration cost, it is not reflected. It is a irrelevant point. Next, retail costs. Retail costs, that is first one, labor related cost. They provided labor related cost was first they are provided warehouse cost. After that they are provided retail store cost, that is labor related cost 33,000. Refrigeration cost will be 1,09,000. It will be taken separately, and other cost will be general cost 47,000. So 33 plus 47 80,000, and 1,09,000 will be separate. And here also same, 27,000 plus 28,000 one side, 55,000, and 1,52,000 will be another side. Okay, if we have got the warehouse related cost, if you know the goods, how much value of goods is sold, then we will divide it by that, we will get the cost per month, cost per unit we will get. Okay, we do know now what is the sale of goods. So average transportation of cost of GIL per trip to any retail stores are as follow. Normal van will be 3,200. And 4,900 for refrigerated one. So for this they are provided cost. If you know the value for whatever 3,200 they are provided, if you know the value divided by value, we will get the cost per trip. Okay, the chief financial manager asked him finance manager to calculate profitability based on 3 products. Okay, fruity and sweety retails. Now they provided that following information regarding to retail stores. It is related to retail stores. We have 2 stores, one is warehouse store and another one is retail store. Okay, number of cartons per cubic 42. So per cubic 42 was provided. This is related to butter jelly, and number of fruits juice was 28, 40, 40 to 28, 40. Okay. Next, number of items of cartons 300, 144, 72. So 72, 42 into 300, we will get number of items. Next, 28 into 144, we will get the number of items of fruit items. Next, IC cools 40 into 72, 40 into 72, we will get the total number of items. Next, time in warehouse. So it is provided warehouse in month, that is 1, 1.5, 0.5, 1, 1.5, 0.5. Okay. Next, if you know the what is they provide, retail store was 1 to 1, 1 to 1. Okay, this is months. Next, selling price per unit, that is 84, 42, 26. Purchase price was provided. So for this selling price minus purchase price, we will get the gross profit. Okay. Next, for this additional information was provided. Total value of all goods sold per month, so 40,000. So here we calculate the warehouse cost and retail cost is calculated. For for warehouse cost divided by this total value 40,000, 25,000, we will direct, we will divided, we will get the per month cost per month. For that cost per month, we will take that cost per month. For that cost per month, we will get that amounts will be taken and we will calculate that. Next, after that, carrying value of each one will be 64. Carrying value, its value will be 64. Okay. And value provided means for transportation cost, they provided transportation here normal one 3200 divided by 64, we will get the cost per trip. Next, for this we have calculated the warehouse related cost, we are calculated, and retail related cost we are calculated, and transportation cost we are calculated. 3 items was calculated, and number of items was also calculated. Number of items, how we calculated, 42 into 300, this is number of items we are calculated. And what is the cost we required per month we are required, and they provided one timings, no, the time in warehouse, time in retail house for 1 month, and cost per month we will require to calculate, it. Okay. Next, for this we will see the answer now. Direct productivity profitability DP statement. So selling price minus profit price, GP, we are already calculated for that. Next, what is the for that we will take the direct product cost. First we will take the warehouse cost. How we are calculated the warehouse cost? Warehouse cost is, for they are provided the time, 1 month, 1.5 month, and 1.5. For that we will multiply with the cost per month. What is the cost per month? And they provided here they provided, firstly we are calculated from year 27,000 and 28,000 for this, and divided by 40,000 value is provided. For with this we will get the answer. Okay, see, let's see how they calculated. So 27,000, 1,52,000, 28,000, 55,000, 1,52,000, 40,000, 35,000. So 1.38, 6.08 is cost per month, and this is taken here 1.38 plus 6.8. For that they were provided for time in house warehouse into total cost. We will get the total cost. For total cost we will take here warehouse total cost, same like as retail also. We are calculated. How we are calculated the retail cost? For this we will take the first related cost and divided by value, and we will get the cost per month, and that cost per month we will calculate for total cost. We will calculate the total cost. For the total cost, 1 month was provided 6.36. So they provide that retail cost 4.36, 2 plus 4.36, and for fruits and nuts we will not take. because they provided only butter jelly and ice cools, only. For this 4.6 we not take for refrigeration. For only refrigeration is required for butter jelly and icy cool items. Refrigeration is only for that two items. Remaining one item, that is fruits and nuts, we will not require any uh, refrigeration, because fruit and sweetie retail stores rather than traditional method calculating the profitability. Next, here why we are taking refrigeration only for that, they provided in question here, they provided, see butter jelly and icy cool are required to kept under refrigeration, so that but these two items we are taking the refrigeration cost also, okay. After that, what we are got, warehouse cost we got, retail cost we are got, and after the transportation cost per tick we will taken, and volume will be divided, we will get the cost per trip. And after that, transportation cost is provided here, DPP statement, cost per transportation provided, okay. Total DPP cost, we will get the total cost DPP cost. Next, items per units. So items per units, for this we will see that working note another was provided now. For number of items was calculated here, number of items, this is number of items 42 into 300 items, so that is number of items will be 12,600, 4,032, 2,880. That is here we will provide the items per meter, item per m. Next, we will get the cost per unit, this is total cost per items and direct productivity cost. Next, a minus b, we will get the direct product profitability. After that, next concept will be customer productivity analysis. What is there in customer productivity analysis? It is productivity in many organization, it is just important to cost customers as it is to cost product. It is a cost product where there may be different customers and group of customers and differ their profitability. Not all customers cost the same to serve, even if they are same product. Even you are purchasing for same product, they may be some cost different. For example, I am in one area and another person in one area. We are going for purchasing one product. For purchasing that product, iron cost was increasing different, that person cost will be different, because we are transportation is different, and if you purchase it in another shop, they will sell in another way, and we purchase it in another way, we will get the different price, even though we will get the same product. Next, some customers may be located in a long way for the factory and transport the may cost. Yes, what we provided, that only they are telling. Next, here benefits of customer profitability analysis. For example, they provided that service organizations such as bank or hotels in particular need to cost to customers. Hey, bank activity, where what is the bank activity, type of activities: withdrawal cash, unauthorized overdraft, request for statement, stopping a check, returning a check because of insufficient funds. For this is the there. Next, benefits of customer profitability. What is the benefit of customer? Here we will identification of profitability for customers and non-profitable customers. Who is the profitable customer and who is the non-profitable customer? We will identification and provide that. Based on, we will construct the dialogue between buyer and seller to improve margins. This is the benefit of customer profitability analysis. For this, they provided one illustration. Illustration number 3. Okay, here what is they provided? A and B are two customers of XYZ Electronics Limited, a manufacturer of audio player. Selling price per unit is 5,400. So he is selling 5,400 rupees, manufacturing a audio player. Selling price will be 5,400. Okay, selling price 5,400. Okay, next, it has two customers, so we will take the First, what we want we will see. Analyze the profitability by comparing profit per unit for each customer. We require for each customer. We have two customers, A and B. So we will calculate the customer profitability statement. For customer profitability statement, we will take the customer profitability statement particulars and customer A, customer B. So we will require for each customer A, customer B. Okay. Yeah, and that for that they are providing the units and relating information. For that they provide the selling price. Selling price will be what amount they are providing. Selling price will be 5400. So we will take for A 5400, B 5400, and after that its cost of production per unit will be 4420. So variable cost, its variable cost will be 4420 for A, 4420 for B, 4420. Next, additional cost are order processing cost 2000 per order. So they are for 2000 rupees they are taking 2000 rupees per order. We don't know the how many orders we have. We don't know how many orders we know. If you know the orders into multiply with 2000, we will get the amount. Additional orders we will deducted from sales amount. Next, delivery cost 3500 per delivery. If you know the deliveries, how many deliveries were there, into we will get answer 3500. For that they provided audio players purchased numbers was 350 and 500. So units, sale units will be, if you purchase that unit numbers, that only you are selling. So 350 units and 500 units. 350 units for customer A, 500 units for customer B. Okay. After that, what they provide, number of orders. For these orders we have order processing cost 2000 into 5 and 2000 into 5 and 2000 into 10. We will get the order processing cost, and after that they provided for each of 70 units and each of 50 units. Okay. Later on that say 70 units. Okay. Number of deliveries were provided. For this we have delivery cost 3500 into 5. 3500 into 5 will be 17500. It is only for customer A, because maybe reason for they is purchasing less cost, so we are collecting the delivery charges. Next, we are from this we are got this, what we have got, quantity, that is numbers, units 350, 500, and sale price 5400, and variable cost 4200, and delivery cost will be 3500 into 5, and order cost we will got the 2000 into 5 and 2000 into 10. For each customer we got this much of information as of now. Next, later what provided, the company policy is to give a discount of 5% on selling price on order for 50 units. So if any person order for 50 units, you will get the 5% discount. So our customers were purchased 70 units and 50 units, so both persons will get the 5% discount on which selling price will be 5400 into 5%, 270 is 270. So it is a quantity discount. Next, later on that and further give 8% discount on undiscounted selling price. So undiscounted selling price we will get the 8% discount. Okay. If when we will get this 8%, if customer uses his own transport of collect the order. Okay. Order cost. Okay. If here see what is they providing, 8% discount of undiscounted selling price if the customer uses his own transport collect the order. So who is the person using his own vehicle, we will give the delivery discount. Here we charged the delivery cost for customer A. So delivery cost we are charged means we are providing the delivery. So customer A, and customer B we are not charging any amount, maybe he is using his own vehicle, so B will get the delivery discount. That is the logic here. Next, analyze the, so first we are got the quantity discount and delivery discount. Quantity discount is for both persons and delivery discount is for only customer B, because customer B using his own vehicle. How we are finding, because we do not charge the delivery charges. Next, customer profitability statement. Customer A, customer B. Sales units 350, 500. Selling price will be 5400, 5400. Discount, quantity discount will be both percent, 270, 270. That is 5400 into 5 rupees, 5%. And discount delivery will be only for delivery customer B, because he is using his own vehicle. Next, selling price, net of discount Y 5110, 4698, and variable cost which is provided as a purchase cost. Next, cost of production, so 4420, 4020. Contribution, we will get the contribution, and total contribution will be, they provide the units 350 units and 500 units, so we will get the total contribution. For this we will deduct the order cost and delivery cost. Delivery cost is only for customer A, and order processing cost for both the customers, and per customers per profit for customer will be 2,21,000. That is contribution deducted by all expenditure. We will get the 2,21,000 and 1,19,000. And for this 2,21,000 divided by 2,21,000, the profit for customer, we will get the profit for customers. For that, profit for customers will means 2,21,000 divided by how many units is there, 350, divided by 350 will be, we will get the 631.43. and same like as 1,19,000 divided by 500, we will get the 238 rupees. Next, analysis means even A has lower sale value. A has a lower sale value, that is for what is the sale value, 350 sale value. It is contributing almost double profit, so is less value, but is have more profit. As we see here, the profit will be 2,21,000 from customer A only. Next, almost double profit that is being distributed by B. Overall discount offered to customer A is quite less, because maybe reason for we are providing more discount to customer B, that is we provided a delivery and processing costs, processing delivery discounts. Next, comment on discount policy and delivery. So we will require to comment on delivery discount policy and delivery. Discount and delivery offered to customer B, so is 430 rupees. How we got the 430? 5,400 into 8%. Why we will get the, because he is using his own delivery van. How we got that information? Because we are not charged the delivery cost. Next, if transport of for delivery is provided to customer B, then cost would be 70 rupees per unit. That is 10 deliveries into 3,500 units. So we will collect that amount, which is lesser by 362. It may also be noted that delivery cost in case of customer A is only 50 rupees per unit. That is 17,500 divided by 350 units and 50 rupees. Hence, company need to review discount policy on delivery, but significance of profitability of customer B should also be kept in mind while doing so. That is related to customer, what we are discussing, customer profitability analysis. Next, what is their ABC in advanced manufacturing environment? Here, in advanced manufacturing environment, where support function overhead constitute a large share of total cost. So which is the support function overhead is there? No, it will constitute the large share of total cost. There ABC provides more realistic and accurate product costing for this. And here work, the global competitiveness, work automation. Next, activity based cost management. It is a one discipline. It will focus on management of activities, has a route to improve the value received by the customer, and profit will be achieved by providing these values. Here the discipline includes cost driver analysis, activity analysis, and performance measurement. These three disciplines will be there in activity based cost management. So for that, above we are discussed about, it is a manufacturing environment and it will support function for overhead. It is a only support function for overhead, so it will constitute for share capital, and it will provide more realistic and accurate product costing. Here activity based cost management means it is a discipline. It will focus on management activity routing to improve the value received by the customer, and we will achieve our profits. And for this, these have three drivers. What are the three drivers? One is cost driver and another is activity analysis, another one is performance measurement. This is they provided that activity based model, cost drivers, performance measures, and cost drivers, activity analysis, performance analysis. Okay. Designing and implementing ABM. So cost driver analysis, activity analysis, performance analysis, that is 3 methods is there. Next, value added activity. It is value added activity and non value added activity. Means value added activity means are those activities which is indispensable in order to complete the process. It cannot dispensable. If you that dispensable, then you cannot complete our process. That is value added activities. Here the customers are willing to pay for these services. So the only 2 points mainly: the activities which is indispensable in order to complete the process and which are customers is willing to pay amount, that is known as value added activities. For example, if you take polishing furniture by manufacturer, dealing in furniture. If you are taken for furniture, if he is not polished the furniture, it is not look good. So if you furnish, the customer will also ready to pay for that furnishing, polishing. That is the value added activity. So the for that activity the value will be added if you polish the furniture. Next, value added activity was provided. Next, non value added activity. So they provide methods for determining whether the activity add value. So that is the activity is necessary. If yes, it is a value added activity. Next, if the activity efficiently performed, if it is useful to adapt budgets, targets or external benchmarking to establish value added baseline, then it is value added. Next, is an activity sometimes value added and sometimes non value, then needless movement of raw material, then it is a non value added activity. However, sometimes it may be needed to transfer working progress units between production operation, and it is a value added activity. Next, what is meant by non value added activity? Non value added activity means it is representative work. It will not add value by the external or internal customers, and non value added activity do not improve the quality or functions of product or services. It will which adversely affect the cost and prices, Next, here this activity creates waste, result in delay of some sort of cost, products, services which the customer is not willing to pay. Moving materials and machine setup for production run. Here these are the example for non value added activity. That is how the manufacturing operation 5 major activities are often cited as wasteful and unnecessary. That is storing is not required, and moving. Next, waiting, inspection, scheduling. These 5 are non value added activity. Next, test your understanding. A wind manufacturer stores a wine, and here the manufacturing of which is already completed but which needs to be stored for a specific period to meet the quality standard specified by customers. You are required to identify value added and non value added activity. Here the wine which is drinking the wine, it will not complete if it is not stored. So that storing is adding value to the product. It is a value added activity. So what is the provided? If a wine manufacturer stores a wine, the manufacturing of which is already complete but which needs to be stored for a specific period to meet quality standard specified by the customer. When customer will pay the value only when it is good, but such storing time would be considered as a value added activity, since without this storing activity manufacturing of wines of specified quality would not be complete. Note, the quality and price of wine enhances as it grows old. It will if it is a old, we will get more money. Next, are they provided? A non-value added activity in most operation, time is spent the following ways. how we are spelling receipt time, manufacturing process time, manufacturing cycle time, etc. etc. Cycle time, these all are non-value. Delivery time, customer response time, and they provide concept. Companies that can eliminate waiting time for services will find it easier to attract customers, and the time taken to process mortgage and loan applications by financial institution can involve a considerable amount of non-value weighted activity time. Next, thus reducing the time to process the applications enhances customer satisfaction and creates the potential for increasing sales revenue. Next, application of MCE in reducing the non-value added activity. Next illustration number 4. We will see the illustration. What is there in illustration 4? In illustration 4, they provided that Kunstone furniture. What he is doing? Manufactures high quality wooden doors. So he is doing high quality wooden doors within forest. So he is working in forest only since 1952. Management is having emphasis on creativity, engineering, innovation, and experience to provide customers with the door they desire, whether it is a standard design of one kind customer doors. The following information pertain to operations during the April. So what is the provided? Processing times 9 hours, inspection time 1.5 hours, waiting time 6 hours, moving time 7.5. So what is the total time is there? We will get the total time. That is 9 plus 1.5, 9 plus 1.5 plus and 6 hours plus 7.5. So we will get the 24 hours. 24 hours will be total production time. It is a total production time. Next, units per batch. It was 60 units. Okay, what is we required? Average time per batch. What is we required? Complete the following operational measures. Average non-value added time per batch. So here non-value added fact will be inspection time, waiting time, and move time. So inspection time value 1.5 plus and waiting time will be 6 and movie time will be 7.5. So 28 whatever the of 1.5 6 7.5 means 5, 0.58, 1, 9, 9 plus 6, 8, 15 will be a non-value added. Next, what is they provided? Average value added time per batch. Average time per batch means processing time. Value added means 9 hours. Next, manufacturing cycle efficiency. Cycle efficiency means whatever the time is there, processing time divided by total production time. Total production time will be 24 hours. That is 9 plus 1.5 plus 6 plus 7.5. So 9 hours divided by 24 hours. We will get the manufacturing cycle efficiency. Next, manufacturing cycle time. Manufacturing cycle time means total production time. What is this? 60 units. That is total production time divided by units per batch, 60 units. So 24 hours divided by 60, we will get the manufacturing cycle time 0.4 hours per unit. So solution will be average non-value added time will be per batch, inspection time plus waiting time plus move time 1.5 plus 6 plus 7.5, 15 hours. Next, average value added time per batch processing time is equal to 9 hours. Next, manufacturing cycle efficiency will be processing time divided by processing time plus inspection time plus waiting time plus movie time. That is total time. We will get the manufacturing efficiency. Next, manufacturing cycle time will be total production time divided by units per batch. That is 24 hours divided by 60 units. This is related to that. Next, after that we will see the business application of ABM. Business application of ABM and ABM ABC differences we will see. Business applications of ABM will be, it will be cost reduction, activity based budgeting, business process re-engineering, benchmarking, performance measurements. Where cost reduction was provided, activity based provided, and benchmarking means was, performance measurement means was. Performance measurement means areas we will see the measures. Next, implementing ABM. First, for implementing ABM, we will see the 7 steps process. It is a 7-step process. What is the 7-step process? First, we will decide what are the organization's most important issues. We will decide what are the most important issues in the organization and what type of information would be required to address, and address to those issues. Next, top management support is cited to identify critical information need. Next, incorporate ABC method into organization financial reporting processes. First we decided some issues, and from some issues we will take the top management support. From top management information, so we will get the support and we will get the information. From that information we will analyze the ABC method. From that ABC method, which is main, and implement the team should be represented by people who are actually users of ABM information. For this ABM information we will implement the team. Next, after that, this existing information system should easily support input requirements, and after that integration ABC into main cost reporting system, it is not feasible. Consider develop a separate ABC system and implement ABM at higher level in order to concept across. This is the 7-step process. And what is the benefit of activity based cost management? It will excellent base and focus on cost reduction. It will focus on cost reduction, and it will provide operational management clear view how to implement the ABE budget, activity based budget, and here provision of clear understanding will be business process cost, that is process improvement. Next, process of excellent base for effectiveness of management decision making. Next, key resources of management. Next, they provided that difference between ABC and ABM will be: ABC refers, it is a technique for determining the cost of activity and output of this activity produced, and ABM means it is a management philosophy that focus on planning, execution, measurement of activities as a key to competitive advantages. Next, where ABB means activity based budgeting is a process of planning and controlling the expected activities for the organization to derive a cost effective budget that meets forecast workload and agreed strategic goals. Here key elements are type of work activity performed, or quantity of work activity performed, or cost of work activity performed, TQC. Next, here activity based costing will go in downside, resource activity cost objects, and here activity based budget will be forecast activities resources, that is related to that. And they provide one illustration number 5. 612 is Indian, just a second. 612 is an Indian Japanese international chain of convenience stores for food, snacks, hot and cold beverages. Is formulating the activity based budgeting for January 2019. 612 has only 3 products, that is soft drink, fresh drink, ready to eat food. So he has 3 products. For this we are providing budget. So particulars and 3 items will be taking. Okay, first category. Next, they provided that activity. Firstly, what we are required to see, what is we required? Complete total budgeted cost. So we require total budgeted cost. Okay. Next, discuss the advantages. Okay, advantages will be discussed based on activity based budgeting and a percentage. Next, complete total budget cost for each activity in 2021. So we will calculate for January month and March month, and we see the same budgeted for January month. Next, state the benefits of tool adapting Kaizen budgeting approach. If you adapt the Kaizen budgeting approach, what is the benefit, and we will identify the limitations. Okay, so we need to calculate the budget for January month and March month, and we will provide the what is the limitations and what is the advantages we have. Okay, for this we will see the question. What is they provided? First, ordering per purchase order. They provided the actual rate 5,000. Okay, and budgeted rate was 4500. We required budgeted only. 4500. So 4500, and for the soft drink it was 16. So 4500 into 16, we will get the answer for soft drinks. And 4500 into 20, we will get the fresh drink ordering. Next 4500 into 60, we will get the ready to eat food ordering. Next delivery per order 4100, same like as 4100 into 13, 4100 into 60, 4100 into 20, we will get the delivery cost. Next shelf stocking per hour, they provide the per hour. Okay, 1050 rupee, 1050 into 15, 1050 into 170, 1050 into 93, we will get the amount. Next customer support per item sold. So 9 into 4500, 9 into 4600, 9 into 10500, we will get the amount of ready to cost. So we are got the order cost, delivery cost, shelf costing, shelf stocking, customer support, services. So what is the tabular formula? We will take this activity and we will take the all soft drink, fresh drink, ready to eat food. Next for this. Okay, after that 612 has to continue improvement system to budgeting monthly activity cost for each month in 2021. February budgeted cost drivers rate is 0.996. So they provided cost drivers rate 0.996 times. Okay, and the budgeted of January. So February budget will be, it was changed to 0.996 times. Next okay, March budgeted times will be 0.996 times. 0.996 times. Okay, so what is the, we will get 4500 into 0.996 means we will get the February rates, and for February rates whatever the amount we will get, for that we will into 0.996, we will get the March month rate. For March month rate we will get, from March month rate into this quantity 16 into 20 into 16, whatever we have done in January month, we will do the same activity in March month. For that we got the rates for year, so 4500 into 0.996, we will get the February rate, and for that rate into 0.996, we will get the March month rate. Next required, so we will get the answer easily. That is, we have got the first answer easily, that is whatever we are discussed, that is there here. And second will be, we are seen the percentages, though we are converted the percentages, because they asked for percentage, no, in second they asked for product as percentages, so we are converted the percentages. For that we have taken the totals, okay, that is 72,000 divided by 2,34,000, 90,000 divided by 2,34,000, and 72,000 divided by 2,34,000, it will be 30.77, and 53,000 divided by 53,300 divided by 3,81,300, total whatever the amount is there, amounts divided by total, we will get the percentage, no issues. And after that we will there, okay, other benefits cited by managers includes, that is, it will be better identification of resource needs and clearly linking of cost with staff responsibilities, identification of budgetary slack. So here they provided the cost hierarchy, ordering and delivery related to batch level, and shelf stacking and customer support will be output levels, it is related to output side. Next this is rates we are calculated 4500 into 0.998, we will get the February rate, and for that 0.998 we will get the March month rate, they are provided. For that rate we will take into same, and quantity we will get the quantity, we will get the rate. For that rate we have already there they provided for amounts, so for that amounts we will get the answer. Next fourth point related to Kaizen costing. If you go for Kaizen costing, what will be happen? for this Kaizen costing. Part 2, that is we will take the order cost for 2,32,131, 3,78,256, 289,567, 4,42,928. And for part 1, for January month we have 2,34, 3,81,300 and 2,91,900, 4,46,400. This is Kaizen cost. So commitment to organized cost reduction. Is their cost reducted or not? For ordering, cost was reducted. Delivery, cost was reducted. Shelf stocking, cost was reducted. And customer support, cost was reducted. Kaizen budgeted number will show unfavorable variances for managers whose activities do not meet the required monthly cost reduction. This is likely will put more pressure on managers to create sick out. If the cost is not reducted, then we will put the pressure on our managers. They will work for organization better working. And on one limitation of Kaizen budgeting as illustrated is that it consider minor incremental improvement in each month. Minor improvement, there is no major improvement, and it is possible that some cost improvements arise for irregular fluctuations in operating process, supplier network, customer interaction. Companies need to highlight the importance of seeking these improvements as well as minor incremental improvements. This is related to that. Next, last one was ABC decision making. ABC decision making. What is there in this ABC decision making? That is, we will for ABC decision making we have TQM, total quality management, and wholesale distributor, that is provided the all points. Practical insight was provided. We will say summary. Okay, completed.